Major funding for this program is made possible by grants from HSH Nordbank New York branch and First American Title Insurance Company of New York, Perfect Building Maintenance, the Moynihan Group. Additional funding for this program is made possible by grants from Anataris Real Estate, C.B. Richard Ellis, Fremont Investment and Loan, Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Wickoff Group, Titan Capital.
Welcome to the Stoller Report, Real Estate Trends in the Tri-State Region. My name is Michael Stoller. Everybody's buying land. Everybody's buying buildings. Everybody wants to own real estate. The topic of my article today in the New York Sun said everybody wants to play Monopoly. There are lenders playing Monopoly. There are buyers playing Monopoly. And you know, everybody really wants to know what's happening. They want to see what's happening. So what do? You bring together 6 leading people, 3 who are investors and 3 who are lenders, and you try to put them together on a perspective of what's happening in the market today. My guests today include James Fitzgerald, Senior Vice President, Head of Real Estate for North America, HSH Nordbank.
Correct.
Robert Rosania, CEO, Stellar Management. James Hedden, Executive Vice President, Head of Real Estate at Bank of America, a returnee many times. My good friend Ofer Yardeni, co-founder and managing partner of Stonehenge Partners. Ben Marciano, managing director and deputy general manager, Eurohypo AG. And last but not least, Alan Weissman, CEO of Alfred Weissman and Company. So, Rosania, there's so much money out there. All these guys giving you the money. You see, right now, You're an investor, he's an investor, he's an investor. That's why I put you all in different seats.
Good idea.
Why is there so much money out there? Why does he want to give you money?
Supply and demand. And he pays it back.
And he pays it back.
Right. That's a bonus in this business.
Jim, you're giving money out.
I'm in the business to make money.
Yeah? You're in the business to do what?
I'm in the business to operate and real estate and to make money and to enjoy what I do.
So if somebody said today they came here with this pot full of money, what type of property is the type of property that you and your investors from around the world and Canada, what kind of property do you want?
To me, it's not just the type of properties that I'm looking. To me is, first of all, I'm only interested in properties in Manhattan. And
Brooklyn is no good?
It's not that it's not good, but for the profile and for the investors that I work with and the returns that I want to achieve, I realize that for my business model, properties that I can achieve the highest returns on properties in the best location in Manhattan, even though I'm buying them at very low cap rates, I still am able to create the very, very high returns. So I really concentrate on the prime location in the city.
And what type of properties do you like? I mean, is it a Stuyvesant town, Peter Cooper Village? Is it an apartment house on West 17th Street?
I think that everybody in this room or everybody in New York would like the properties in Stuyvesant or Peter Cooper. I mean, it's 80 acres, 110 buildings. And if you're operating in real estate, that's your dream. That's the biggest toy that you can buy.
You know.
So absolutely I would like to buy it. But I would buy office buildings, retail, garage, apartment. I would buy the most complicated real estate where you need to really create the value, because that there would be, for me, the best returns. And I like the safety of the apartment buildings in New York, because they are typically 100% rented.
Yeah, you like the risk-adjusted returns, like we do.
Absolutely.
I think the dirty little secret of Peter Cooper Village and Stuyvesant Town is, prior to that asset, most of the traditional institutional equity guys, okay, in other words, the pension funds, the US-based pension funds, didn't have a lot of exposure to rent-regulated apartments in New York or other rent-regulated jurisdictions in the United States. And as a result of that asset coming to market, people realized that the risk in those assets, outside of legislative risk, which we'll put to the side for the moment, the risk in those assets is absolutely the lowest in real estate in general.
And now let's follow. You buy property. You're an investor. You lend money. You lend money. You lend money. Did you look at that transaction? What have you lent money? I want the opinion of the lenders, because my audience wants to know what everybody's thinking about.
Certainly, and it's still looking at it. It was a very competitively bid asset, obviously, and one of the key components to making that asset successful in terms of the financing was the ability to provide an equity bridge type financing. And that in essence is a structure that's going beyond the traditional component of debt. The tranching of that particular structure really goes deeper into the debt stack. And it will come back out into the market again very shortly with respect to the syndication process.
Bank of America looked at it very heavily, and we were teamed up with one of the finalists. Obviously, it was a very aggressive bid project. Exciting. I think, again, who you partner up with and who you finance is as much as the assets itself. And I think there were a lot of quality sponsors who bid on the project. And Tishman is a great company, and I think they'll do very well.
Jamie?
No, we didn't chase it.
Why not?
I thought it would be too difficult to capture at a price where I currently deploy my capital. So, great asset, great buyer, a lot of competition. I'm able to deploy capital in a different way.
So where do you deploy capital?
Cranston, Missouri.
Thank you. It's always good to have friends like you on a show. Now, what do you like? What's your sweet spot? If I came to you and I wanted to buy some type of property, what do you like in the city? I mean, Ofer only likes Manhattan. I mean, you did a loan recently in New Jersey. You like other things. What do you like? What's your sweet spot? What type of
I would
loans?
say I've been bullish on office for several years. I've rejected a lot of these condo projects that didn't differentiate themselves by location or sponsorship. Having said that, I wouldn't say we're ultra conservative. We were happy to be Ben's partner in 15 Central Park West, arguably the best condo project ever built in America, nearly finished now, with record prices. So we were aggressive there.
Good place to be aggressive.
Yeah, retail in Manhattan, but we're active all over the United States. We opened up an office in San Francisco. We've done $1.5 billion there, 6 condo projects with the right sponsorship. So for me, it's more than betting on the best real estate, it's really betting on the best people.
Right. Ofer, you alluded to earlier that exact point, which is now in the market, everybody's in the market for real estate. You said in your introduction that everybody wants to own real estate. In a very mature market, what ends up happening is you get operators and buyers and investors who are otherwise not sophisticated enough, and obviously for Jim and for the lenders in this business, it's better to be with a great sponsor than absolutely a great deal.
But it's not only that, Michael. We're speaking about why people like real estate. I said approximately a year ago in a forum where I was speaking that the national sport in New York is not the Yankees or the Mets or the Giants, it's real estate. Everybody, they think about real estate. They wake up in the morning, they talk to the wife about real estate. They go to, even if they're not in real estate, they make love, they think about real estate. Real estate is the number one sport in New York City. So if it's the number one sport, everybody wants to be here.
Do you remember in the 90s, I think this is when people said you had to get out of the tech boom. Everybody was, day trading, and everybody was saying the next Yahoo, and everybody said, they would go to a cocktail party, and they said, oh, I just made so much on CNET, okay?
I remember that because I was a real estate broker, and I just got married, and I used to go to parties, and with my wife, and everybody felt very bad for me that I'm in real estate. They almost came, oh, we are sorry that you're in real estate. Yeah. But you know what? Real estate is still the safe business here in New York. and I think the yet is yet to come.
Now, Alan has done some interesting things. You've repositioned real estate. Well, tell us what you've done and what you like to do.
We do different than what you do. We stay out of Manhattan. We don't like 1,000 people fighting over a deal. We like to be in control of a market, understand the market, and really not have too many people coming after us. We look for projects that are probably too big for the small investor and too small for the big investor. There's a little sweet spot in there that we have. You're talking about the market and where we are in topping out or not. My father always talks about, you're at the top of the market when dentists are syndicating deals. And we're getting to that point where we're starting to see dentists out there syndicating deals. So it's getting hot, the market, maybe too hot.
Right, but right now you're doing a reposition. Everybody knows Saks Fifth Avenue, and Saks Fifth Avenue a couple of years ago decided to close some of their stores. So what are you doing with the Saks Fifth Avenue in Garden City?
Well, we've bought 2 deals from Saks. One of the deals was their warehouse deal in Yonkers, which was 500,000 square feet. We repositioned the building. We tried to do a retail deal. That didn't work out. We repositioned it, and Quest leased the entire building from us, a telephone company. And
Lucky it was Quest as opposed to MCI.
Yeah, they didn't quite get that one. And then the other deal we did is on Long Island with Saks Fifth Avenue, again in Garden City, and again a repositioning a building, an asset, where we're taking the building, converting it from a retail building to a medical mixed-use type project. So just a little bit different.
It's very interesting what you said. You said you're going to markets where not a lot of people want to be there and competing there.
In terms of developers.
Okay, but look at it, where we are. We are in a market that really the only bad thing about real estate that it's not liquid as the stock market. But if you own real estate in Manhattan, it's as liquid as almost as stocks, because in a matter of even the transaction that we had with MetLife, in a matter of 3 weeks they sold what was reported $5.4 billion transaction. And that in a matter of 3 weeks, unheard of.
Yeah, but right now, there's huge amount of capital in the market chasing deals. That liquidity and that kind of capital hasn't always been there and won't always be here. And so, just because today there's so much capital chasing deals in Manhattan doesn't mean they'll be there tomorrow, and doesn't mean that. Over time the real estate market does go up, but it doesn't mean it'll always go up.
But there's also a spillover effect too, because the capital pushes out to the suburbs and
absolutely.
Now, I don't want to age us, but we have a couple of guys here who are a little older and who have seen some more cycles. Would
you like me to give my opinion?
No, you're too young on this
72
one.
in March.
Oh,
that's all?
You look pretty good for 72.
You look great for 72.
Now,
unbelievable.
We've had cycles. Do you think we're going to have a cycle, Lendis?
Absolutely.
And where is the cycle going to hit? Where is this going to hit?
I don't think it'll be as deep as the last cycle, but clearly we're starting to see a slowdown in the condominium sale market. I think you'll see a slowdown until there's an alternative investment. I think the capital is still going to stay into real estate, and I think that's going to drive how deep the slowdown or the trough is in the cycle. But I think that's why you have to pick the right property and pick the right developer, because I think that's critical to sort of getting through to that next cycle.
Prior to the show, we met with some people, and one of the younger guys said, "What if I find a property and I have no experience and I want to buy this property? I got 3 lenders over here, and I have 2 young guys who are investors. Oh, you're still a couple of years older than them, but you're still young. How do you make a decision to lend to somebody who may be 28 years of age with no experience in
That's
the
an easy
ownership?
decision. It's quite simple. You don't.
You say that, but by our office in Westchester, there's 2 young guys developing in a really C location, trying to build an A- building right near the train station in Yonkers, in downtown Yonkers. And money's being thrown at them from some large institutions, no experience, and everything that can go wrong is already starting to go wrong on the job, from collapse of walls to everything else. So you might not lend, but there's some silly money out there.
I should probably rephrase my statement. I wouldn't lend.
There you go.
But you know what? I remember my first building that I bought in New York. I have no experience. I maybe didn't even have 100,000 in the bank. And I went and I met Sam Giarusso, and I showed him the building. He's from M&T. And I convinced him, and he lent me the money. And you know what? And he supported me over the few years. And there are relationships. He gave me my kids back, yes. Yeah, I didn't have kids.
No, but you know what? I think the question is...
It depends on the type of the deal.
It depends on the type of the deal. You know, people come to us, you know, in my roles and other things, and they say, you know, I found this property, this piece of land. You know, I'll give you an example. A guy who I knew a number of years finds a property in Coney Island. Now, Coney Island has potential, you know, when the rezoning, and he found the property that is rezoned. I mean, it's been improved. But there's never been, and he says, you know, I'm going to make this Coney Island property just like what Josh Musk did in, you know, in the Oceana in Brighton Beach. Now, Brighton Beach, you have retail, you have an established Russian community, and the guy is still shopping, he's in contract, and no lender wants to talk to him. I mean...
There's a component of pioneering associated with that, which when you get down to the basic fundamentals of looking at a real estate deal or financing a real estate deal, what you're doing is you're subsidizing to a large extent what the investors, what the borrowers are going through in order to find deals that basically hit their return hurdles. So that's what's happening on the lending side. In doing that, in connection with doing that, certainly the lending market has to find a level of comfort with respect to making a loan to somebody.
Some component of that deal, because when Josh Mush went into Brighton Beach, I mean, that wasn't the easiest deal in the world either.
Josh couldn't get lenders. There was no comps.
But his relationship with Bank of New York brought the Bank of New York into that transaction.
Plus that project was phased over. If you actually look at the size of the deals, getting back to the example of a couple of small guys really starting out, you have to look at how large that transaction is. That's a big component of it. And when Josh Musk basically went forward, Brighton Beach, that was done in components over a very long period of time.
But Michael, I'm sorry to interrupt, but you asked a question to me at the beginning of the show, and I said supply and demand, okay? I think if you take a look at North America, as industries have gone from kind of innovators, early adopters, to, you know, kind of the sweet spot of the market, as all industries have matured, the people that are in relatively early to that industry have made a fortune, okay? And if you take a look at the real estate business big picture, 15 years ago in the last, let's call it, cyclical downturn for real estate, significant cyclical downturn, if you take out the, you know, kind of Russian debt crisis of late 98, okay? The equity investors and the lenders were totally different pockets of capital than they are today. At the end of the day, they were the same, but today you have represented here CMBS lenders who...
wait, please, my audience doesn't understand what a CMBS lender.
Fine.
And I really think it's important that people can gain, because Jim lends from his balance sheet. So does the other Jim lends from his balance sheet, and you do some of it. Would you explain what CMBS is and securitization so the audience could gain a better perspective and understanding what you mean by this?
It's simple, and obviously there are bankers here that could do it better than I could, but commercial...
I'm going to let them do it too.
Commercial mortgage-backed securities. It's a pool of assets that are secured by real estate loans that are then retraded or resold into the marketplace for pension funds and whoever wants to buy that debt, okay? So unlike Jim, who is almost exclusively a balance sheet lender, right, Jim?
For the most part.
Okay, but you also do some CMBS.
Absolutely.
Okay, but there are very few pure balance sheet lenders left. I think you would, in general, agree with that, right? Mm-hmm. And the majority of these loans have now been sold again, okay? In the equity business, there are very few pension funds that own direct real estate as a percent of their real estate holdings compared to 15 years ago. They own interests in equity opportunity funds and things of that nature.
So in reality, I want to, I heard a guy who I think is the head of Wachovia about a year ago, Bill Green, speak, and someone said to him, "What do you feel? What do you project the interest rates are going to be in 6 months, and what do you feel the markets are like? And he said, I only really look at what's going to happen in 30 days. Because basically he's saying, I take the deal and then I sell it off.
Right.
And I take no risk.
Right.
So if I can find some individual or an entity who's going to buy this, he couldn't care. As opposed to a Sam Giroussa, who could care.
Right.
Or a Jim Fitzgerald who said, hey, you know, the two of you did this deal on 15 Central Park. Hey, it was an expensive property, but it was the greatest property. But then there are people, they were pioneers on 42nd Street in different markets that is a different market, or the far west side, or Williamsburg,
What's fundamentally changed, and I am doing it a long time, is there's been an institutionalization of real estate.
Right.
And you have the ability now, not even just through the capital market, CMBS kind of executions, you have the ability to tranche your transactions. There are plenty of guys who are ready to take high risk, high yield kind of positions. And so the banks of yesteryear, who are still in business today, are selling off those risks to the guys who want those risks. And the business is fundamentally different.
Right.
It's totally
much more
changed.
liquid.
Yeah.
I mean, you buy a property that's completely vacant. You buy a warehouse that the tenant's out, and you buy a Saks. What kind of lender lends you that money?
There are opportunity lenders out there that are willing to put up non-recourse dollars towards acquisition, towards redevelopment. If you have a good plan, if you have a good piece of real estate, there are also lenders out there who will lend even if it's a bad piece of real estate, and
And a good track record.
And I asked some of the lenders here too. Have you noticed in the last 5-10 years a decline in the amount of due diligence done by lenders just because they are able to flip these deals out? Their only risk is 15-20 days, 2 months of hold on them. Have you seen that at all?
Sure, but it depends on the execution, the ultimate execution. In a CMBS transaction, there's a component of required due diligence because you need to get through the rating agencies, certainly. And if you don't do that properly, obviously you will not get your subordination levels. And at that point in time, you have a different profitability level that you're looking at.
I'd like to go. My show airs in 5 boroughs and also on the internet, and people have been very positive. They talk about Long Island City and Williamsburg. Unfortunately, you said you only like Manhattan, so
No. I like all the other boroughs. I like the entire country.
When he's finished buying
I
Manhattan,
don't want
he'll go to Brooklyn.
It's not about that. I just explained to you the same risk that
Yeah.
I have here. I will have in the boroughs, but here I will have a better returns. So I only have a certain amount of hours during the day that I can devote to my business. So I rather focus where everybody wants to be and to compete in the best market in the
Right,
world.
but can I ask you a question? How do you get such high returns if there's so many people competing for the deal and your cap rates are shrinking on the deals being sold? Are you really getting the best bang for your buck?
So I think so, because I'm in, most of my stuff is in the residential business and in the multifamily, in the rent stabilized business. So me and Rob, we would like to buy a 6-7% return, but lately we are buying 1 or 2 or 3% return. But the key to our business is that in every business that you look in office, retail, you are trying to figure what the rents will be in 5 years. Our business, that we are like twins, we are saying forget about growth. If the 1 bedroom is $3,000, forget about growth. If we are buying rent stabilized building at $500 or $1,000 average per unit, the entire business becomes not if it will happen, it's when it will happen.
Exactly
and when
right.
we turn an apartment, we raise it to $3,000. So really, if you will do the calculation, if you have 100 units and you are able to turn 10% of the units, and you are taking it from 1,000 to 3,000, it's 24,000 a year. And if you are selling it at 4% cap rate, you increase your value of your asset by almost $600,000-$700,000 a unit. So really, we don't need to be forecasting future. We don't need to analyze credit of the tenant. We are in the simple business in the world. Just execute, turn over the units, and when you turn the units, you can achieve, and I promise you that his return and my returns, we don't have any deal that we have less than 30 to 40% IRR on a 5-year with a 60% leverage. And I know I'm doing a lot of publicity to them, but we are in the same business, and it is just about execution.
To
And
all the
this is-
sellers that are watching, I don't make 30 to 40% leverage returns.
No,
So I have to sit down with you and to show you
He has
where
to
you're
teach
wrong.
you.
He just took you out of the
But,
market.
but Jim, I mean, Bank of America is such a big lender in all types. I mean, you know, what areas do you feel comfortable? I mean, if it's the right operator, you know.
Well, clearly the sponsor is very important to us, but I think the phenomenon that we're seeing here in New York City is that everybody wants to be here.
Clearly.
And so that allows that apartment that turns over at 500 to go to market because there's a tremendous supply of people, whether they be young. You know, my daughter just graduated college. She wants to be in New York. You know, now that my daughter's graduated college, I want to be in New York.
Yeah, but
You know,
now
so everybody wants to be in New York.
relating that question, you know, not everybody can afford. You know, I have people who watch my show all the time know that I'm this major advocate of affordable housing. You know, the kid who graduates college, the working person, can't afford an apartment. So,
But their parents can afford their
But
apartment.
wait a second,
There's
they
a tremendous,
share. They
there's
share
a
the
They share.
tremendous,
It's not as
there's a
They
tremendous
share.
amount
My
of
daughter
wealth.
needs an apartment. Can I mention that on the show?
Yes, I agree with you on apartment.
Okay.
No
I-
problem.
But I think the phenomenon is because I to some degree I agree that they're psychologically everybody can't afford it, but somehow we talked earlier,
They
rents
all
seem
come
to be
in.
pushing, condo prices seem to be maintaining. I think there's been a slowdown of absorption, but clearly there's still a demand, and that's really what's pushing the development out to Williamsburg, out to.
But do you think Williamsburg? This is not to you. It's an open question to everybody. You know, Williamsburg is nice, but there's one choo-choo line. Okay, there's one subway line, and water taxis are expensive, and the subway line can't really absorb it. Can all these developments in Williamsburg and these planned developments in Long Island City make it?
But Michael, you hit on the point, which is people today are willing to pay for amenities and lifestyle. So his daughter, who wants to live in New York City, I presume that means Manhattan.
Correct.
Okay, wants to for a lifestyle reason. So she's willing to, quote unquote, give up living by herself to live in a share apartment because she wants to have access to the amenities, nightclubs, restaurants, museums, this and that and this and that. And so places like Williamsburg and Long Island City will always be a secondary location to prime Manhattan. Nothing against them.
It's like
Okay.
Hoboken, New Jersey. It's the same.
Absolutely.
It's a secondary
My daughter would
market.
love to live in Manhattan, but she'll probably end up in Williamsburg or Hoboken because she
she's
can't
priced
afford
out.
it.
And that's okay. And the moment
wait
that
a
she
second.
can afford, she will move to the city.
In Hoboken, there aren't that many rentals. There are more condos. I mean,
That's
No,
not
no.
true. There's
not.
there's
Yeah.
very many rentals.
But guys, it's not only the people that want to live here. It's look at all the investors, the foreigners that wants to come here.
good point.
Yeah.
Today, all this money from Dubai. I mean, at one time, you worked for a Japanese bank. The Japanese were buying all over. Today, it's all these Dubai.
It's not just Dubai, it's Qatar and a lot of people from Israel. People from all over the world wants to be here. And most of my investors are foreign investors. And I think that other than it's the safest place, even though 9/11, and it's very, very busy and culture, it's very interesting. I think if you will go, I don't know how many of you try to do business in France, in Germany, in England, or all Europe. It's very, very tough to do business in those countries.
Very
and it
difficult.
doesn't matter how many you will own, you will never consider as a local player. So if I go and I buy in Germany, they will say he's an outsider. If I come and I buy in New York City one building, a local player, they would say. So here, they do not make a difference if you are from Dubai, from Israel, from Paris, from London. It's the community embrace the investor, and they make the investor feel at home. And for this, you have to add a certain, at least 2 points on the cap rate, because you are welcome.
Right.
I went to France, I tried to do a deal, it was impossible. most of them hate themselves, and here you come with an accent, and you try to negotiate
Hey, that's
a deal
why he
there.
left working for a French
Even
bank.
with that French accent, they didn't accept
It's
you?
impossible. And I have French partners that are Canadian, and you
You
have
have
to
real
see
French partners.
how they treated them. So, or to go to Germany is not an easy place to do business.
You come with me, we'll make it
Okay,
easy.
but the
Ben,
point
you-
here, when you come here, every bank will sit with you,
Right.
every seller will sit with you, because this is, everybody feels at home. So this is very crucial and very, very important, especially about New York.
Relating to this, you know,
I agree with you.
last year the tri-state area had record sales of maybe 28 billion or 27 billion. This year it's
over
going to
30.
exceed
Gonna
over
shatter
30.
that.
It's
Right.
30, 32. This year was a year, I mean, it was never a price point of $1,000 a square foot for an office building being sold.
Or even residential, and we reached that level.
Right. But I mean, why? I mean,
Let alone a vacant office building.
a vacant office building. I agree, but you know,
people wanna
why
be
do
in New
German lenders? Why? Where do you get your money? You don't have depositors. You know, you're not giving out toasters like they used to give at the banks. Okay, you know, they're microwaves or something
thinking
like
about that.
You're thinking about it. I mean, Bank of America. I see there.
I got a TV from Bank of
You got a TV,
go,
but
see?
why did Why did German lenders? Why did all the money come in that you finance these new condominiums, these major projects? Why did the two of you come here?
I'll let Ben go first.
Well, first off, in Germany, it's not as if there's no play being made there. Eurohypo, for example, is the biggest bank, just got voted largest global commercial bank in Germany. So there's a tremendous play going on with respect to the level of business that gets done overseas. The natural extension to do business in the U.S. is, it goes without saying for all the reasons we've just spoken about. And to continue to grow a business right now is a critical component to have global execution across the Atlantic. It's a fairly straightforward expectation. In terms of looking at it with respect to returns and so forth, no doubt that the returns actually, believe it or not, even though the spreads are so thin on the lending side, and particularly in New York and the local areas, there's still better returns than actually get achieved overseas. So that helps quite a bit.
Fitzy?
I think it was, I mean, it's ironic. I worked for a bank, HSH, that 5 years ago no one ever heard of,
Right.
and yet it's the largest shipping bank in the world by far. We have 30 billion invested in real estate. When I joined, I never heard of this place. And for our institution,
No wonder they hired you.
with that kind of commitment, it was natural to try and figure out how to get into the largest market, which is the United States. But I think it's the reverse of what you said, Offer. If you look at the French, they've been here for a long time, and their share of the market in real estate is de minimis.
Right.
The Germans are probably, and with the Australians, are probably the most active investors here. On the debt side, it was this fear of coming to the United States, coming to New York, trying to compete against that guy down there. I think that fear held them back for a long time. And then when they spent the time on the research and they put some people in place, they were able to deploy capital in a way that was superior to what they did in Europe and in Germany, and they hired the right kind of people and put those teams together.
You know, you hear, I mean, when people who walk around the city and they see the billboards, financing by Eurohypo or HSH or Helleber or Bank of America. I was getting to Bank of America. My real comment was, I don't see those signs financed by Citibank or Chase Manhattan Bank, J.P. Morgan Chase. I don't
Out of
see
the
that.
market.
There's a niche. There's certainly a niche that gets developed over time, and there's a natural tendency that there will be the larger institutions that are always continuously striving towards that one-stop shop, so to speak. They will have the CMBS capabilities, just as Jim was speaking about a moment ago. You've got corporate capability to lend to the REIT sector. You've got balance sheet capability to do the development loans and the more transitional assets. And you have the securitization component of the business as well. So beyond that, by the way, there's all the cross-selling aspects of the business that need to go hand in hand with that. All of the bond aspects, the M&A businesses and all. So the development of that component is one side of the business. And then typically what you'll always have is, which is in any industry, the whole barbell approach, where you're going to have an aspect of many specialized types of institutions that are lending on a more focused basis.
Right, but you know, everybody. I mean, in today's commercial market, if it's a nice residential deal, it's Bank of America in New York. I don't hear Chase.
The reality is they're moving to that platform. You know, as these banks get larger, I mean, Bank of America is $1.4 trillion. What you find, and we've sort of gone through this consolidation over the last 10 to 20 years, there's nothing Bank of America doesn't do. There's at some point Chase, Citibank, there's nothing that they will not.
They're actually doing it right now. It's actually going on right now. It's further development of bringing together a good, strong capability to be this one-stop shop. The real issue is how good can you get at it, and how quickly can you develop it? Because you need.
They can't execute.
I'm sorry though, Michael, isn't the real answer to your question the fact that Citibank and Chase, for lack of a better example, the majority of their quote-unquote relationship lenders are no longer at Citibank and Chase. They're at HSH Nordbank.
I think
They're
I
at
have
B of
3
A.
alumni of Chase over
They're
here.
at.
That's right.
That's my point. So at the end of the day, the bank is frankly only as good as the people that they have. You can't just hire a bunch of 22-year-old kids that come out of college and tell them to do a $4.4 billion loan on Peter Cooper Village. You need to A, have the relationships, and B, have the sophistication. The gentlemen in this room have that. They're no longer at Citibank and Chase.
The critical, that's exactly right, the critical component in terms of developing either the full stop shop versus the specialty component, whether that's in construction financing or just focused on CMBS or the corporate business and so forth, or focused really on transitional, which you're seeing a lot more of, the transitional story assets where you're using the balance sheet. All gets down to the workforce, the quality of your workforce, the ability to attract a good workforce, and then to train these people, and then to retain them, because the market is such that the bigger institutions in developing that whole approach of trying to be a full one-stop shop needs to have the proper people to be able to do exactly those kinds of deals that Rob is talking about.
Yeah, Ofer's not borrowing from somebody that he doesn't know. Okay. At the end of the day, it comes down to a relationship, man to man,
good point.
or man to woman.
Okay, now,
Can I just add one component to that? Because it's very critical. We're talking about who actually left. We do have 3 Chase alumni in this room.
he's giving away cards.
Now he knows you.
The fact of the matter is, the 3 of us right here from the lending side left an institution because they exited a certain component of the market.
Right.
Getting back to where's the niche focus of particular institutions? What do they like to do? Where's their tolerance for risk? Where do they think they can excel and where can they make money? The net effect of that over time seems to have come full circle, because these institutions that exited the market now realize that the critical aspect of being successful is utilization of the balance sheet. And you'll have a lot of the CMBS players that in essence will try as very hard as they can to treat every real estate transaction as a trade, and the net effect of that obviously means less utilization of the balance sheet. But look at the latest transaction that just took place. You have an excess of a $5 billion transaction that which is going to be securitized,
Right.
which has tremendous balance sheet utilization.
I have, last week a friend of mine came in from Florida, and he called me up and he said, I used to stay at this hotel on Lexington Avenue, I forgot what it was, on 53rd Street, and I used to pay $199 a night. He said
That's
they
$499.
wanted $450,
Right.
and
He's lucky that they had the room.
And he said he couldn't get a room
Lucky it
there,
wasn't in
that he had to
Jersey
go to the Radisson.
Right.
So hospitality business is really booming in New York. Do you like it here? Do you like it here? Or, I mean, as a lender, as an investor, what's the opinion of my prominent group?
I'm right now looking at a hotel to develop, not from ground, but to do a rehab for a 600-room hotel. But I can tell you that as soon as I'm finishing, as soon as I'll buy and I'll finish the project, I'm
You'll
selling
sell,
it.
right.
Because this is the herd mentality what's going right now, that people
I
are
agree with
going
that.
and are
100%
trying
agree with
to get on the trend. They want a boutique hotel, they want a fancy hotel, they want a 4-star, a 6-star. I know that when I came to America, I knew about 4-star. Now I hear about 5-star, then 6-star.
Somebody just came out with a 7-star.
7-star. You know, what more can you get at the hotel? Maybe they'll pay you to stay. Maybe that's an 8-star. I don't know. So there is a trend to go for hotel, but don't forget that hotel is a business. And if
Thank you. It's an operating
it's an
business.
operating business.
It's not a piece of, it's more than a piece of real estate.
And we are still living in a world where security is a very big issue, and I hope we will never see any tragedy here in New York, but if there is only one small incident, then hotel occupancy will go from 83% to 11%. So to be in this kind of a business and to pay the prices and to go with the herd mentality, I will try to take advantage of the situation, but not to be in the business. In fact, I always try to go to shift to other businesses where people were shying away. So yes, if they are lending and they are selling their loans, of course they are going to do financing for hotels. But somebody at the end of the day will have to sit with the product, and the returns would be
a number of years ago, in the mid-90s, there was a big trend to assisted living. The baby boomers and all of this with the assisted living. And all of these assisted living that were built, a lot of them went bankrupt. They all went. Now, recently, last week it was announced that a chain called Bristol Assisted Living, 5 assisted living in very classy properties in Long Island, were just sold to a REIT, a Canadian-based REIT, spending $300 million. You're in the assisted living. New York City doesn't have that much in assisted living. No. Why do you see that? Well, yeah, but we have people here who would like to be there.
Yeah, it's more than assisted living. You know, it's senior housing, it's age-restricted, independent living, which is our focus. It's kind of like making an evaluation on a rental apartment. Mm-hmm. Then you have assisted living, which is some more services, and then skilled nursing. You know, you've had assisted living in Manhattan for 100 years. It's called the Waldorf Hotel. You have an apartment there. Right. You have a companion, your doctors are nearby, you have your restaurant, all the amenities that you have in these places that are being built today.
But that's for a certain person. We're talking about an age-assisted where the price was, let's say, $3,000 to $4,000.
You can't find places like that in New York.
You can't find it in New York, but you can't find it. We just did a deal like this in Brooklyn. There are a few in Manhattan, but you go to Long Island, the 5 that Jan Furman just sold. Yeah, it's too expensive in New York. Only the very, very wealthy can afford to do it the way I mentioned.
There is one in Battery Park, I think.
Yes,
where they are doing extremely well, but they charge $8,000, $10,000 a month.
Yeah, it's very expensive.
Speaking of Battery Park and Lower Manhattan, I'm very positive on Lower Manhattan. I've always been positive. I'm not even going to allow you to say one word about Lower Manhattan.
To drink lately?
Mr. Rossani has his office in Lower Manhattan.
We do. We do.
But have you really developed in Lower Manhattan?
The problem with Lower Manhattan, we sold 14 Wall Street, 14 months ago, because we saw an obvious issue with all the office coming online. Okay, there's no secrets. Our building was, I don't want to say functionally obsolete, but it certainly wasn't. I jokingly have said that the building had more columns than the Parthenon. And downtown office space, aside from residential, is much older than Midtown, okay? And personally, I would not be bullish on downtown office. I know there are plenty of people that are, and I think with the supply that's coming online downtown, 10 million plus or minus feet in the next several years, you're going to have a kind of weight to the market, okay? And I know that residential is coming down there and it's becoming more of a lifestyle place to live, but it's not a place that we have a significant exposure to.
Jim?
We've done several projects with Glenwood and Rock Rose downtown, and they've proven to be very, very successful.
But admittedly, those Rock Rose assets they bought for next to nothing.
No, I'm talking about residential new product.
Right.
great. They've done fabulous.
Phenomenal, but most of those Rock Rose products were built
They
half a
paid
dozen
maybe
years ago.
$10 a square foot,
Right,
not
they paid nothing.
$300.
No, he's
For the
talking
land.
about brand
I'm
new.
talking about new
development.
development.
No, I
I'm
know
talking
that,
on
but
Boat
they
Street.
bought the land half a
Absolutely.
dozen years ago for nothing.
Absolutely.
Right, that's different. If I could buy the land for $10 a foot,
And
But
Ben-
there's land leased property. This Battery Park is the land lease component.
Right, but-
the Millennium projects we finance, the
Absolutely.
newest
Right.
project we're doing with them as well, which the Ritz-Carlton we had already done. There's some rental down there as well that we've done.
Do you think there's
80-20.
do you think there's too much rent, too much new residential being built downtown?
There's a lot
Condo or
going
rental?
on.
No, I mean, I
The
think it's all been
rental is
absorbed.
fine.
I don't
It's-
see
it's
of
a-
any,
it's-
there's no high vacancy rate of residential down in
I
Lower
think that they
Manhattan.
will have, because I don't think that there is any tenant, commercial or residential, wake up in the morning and say, I want to live downtown. Now, let's not confuse. Downtown is not
Just because you
Boho
and I one night-
next to Cipriani.
Right,
When I'm
right.
saying downtown,
Downtown's
people
not
are
Tribeca.
confused. They think downtown it's Tribeca and Soho.
No.
These are prime. I'm speaking about City Hall and the financial center. And I want you to know, I've
the
been
story.
there.
Tell our
We
story.
don't need to go to this story, but I was so depressed being there, and I just wanted to live from the area, because I never met yet the law firm or the commercial tenant that says, I want to be downtown. Maybe Joe Moonian likes to be downtown, but I mean, if you will look at really all the big landlords that have office downtown, office buildings, none of their offices are in downtown. They all prefer to be in Midtown. And transportation is horrendous downtown. It's very narrow, very dark. And I think that most of the people that are moving downtown are because of subsidies, if it's a tax incentive that they got on the residential. And the same thing for the commercial. Once those tax abatement will expire, once the tenant that moved to the residential will have to pay the full rent without concession, those guys are moving from there. They are going to go.
I'm
I
not
don't
as
know if I would
bearish.
agree.
I'm not as bearish as
I wouldn't
Ofer
agree
is
with
on downtown, but I think it's clear to say downtown lags midtown.
Absolutely.
Okay, in every way, shape, and form.
Absolutely.
But beyond that, I mean, there is certainly a whole transformation taking place down there with respect
No
to
question, that's true. No
And once
question.
that fully gets
And
developed
what
with
about
the restaurants
what about
and so forth.
across the Brooklyn? I was born in Brooklyn. I like Brooklyn. What's the opinion? Would you lend in Brooklyn to an office building, or
I lend anywhere.
you lend in-
We're already.
It makes sense.
We're
He's
in
in
the midst of
Baghdad.
that.
I will even land in Brooklyn.
you like Brooklyn?
Of course.
Brooklyn's beautiful.
And what about Jersey City?
It's booming. It's 10th largest city in the country.
The question is not, every part that you mention here is beautiful in a rising market. We as an investor, and I think there as a banker, they have to look at it. What happened if the market change? What if the market change by 10, 15%? What if it slows in the economy? So we are almost like recession-proof, Rob and I, in our business, because we are willing to live with the returns. Hopefully they'll increase. But all those places like Brooklyn, Long Island City, Hoboken, what happened to those properties that were leveraged 80, 90%, that they cannot have growth in real estate, but they have growth in real estate taxes and water and sewer and insurance? What happened in those moments?
Every piece of real estate is AAA at the right price. So if you have that high leverage, then you're exposing yourself to an issue. I mean, there have been properties in Manhattan offer that actually went sideways, and banks took them back. And
Absolutely. I bought some of them.
has happened here.
I bought some of them. I
By the
sell
way,
them.
I'm waiting for it to happen again.
You will have to wait a long time,
I
I think.
know.
But
Unfortunately,
we were talking before. Alan converted this building in Yonkers. White Plains, the rents in White Plains, as I said prior to the show, 20 years ago they were $28. They're $28 today.
right. There's no velocity
but
in
the,
that
the
market.
difference, though, is over the last 20 years, the Westchester marketplace has transformed from basically a Fortune 500 base. IBM had huge holdings there, MasterCard, all the big players were there. And all these big giant elephants, these white elephants that were left vacant, have all been broken up for smaller users. And they are filling in, and the vacancy has dropped. And we are starting to see in Westchester, rates are starting to climb for the first time literally in 20 years. But it is a different market. It's a different real estate market than it was 20 years ago when the big corporations left. And it's a better place. And there's also a lot more people moving into Westchester. If you look, I drive south on the Hutch in the morning, and you could actually see there are actually more cars going north towards White Plains than there are south going to the city. So there's a market. I'm not saying
I think a lot of those
Midtown
people are
Manhattan,
on mass transport.
but my point is that it is growing up there, and that the market is getting better. It's not, it's not Midtown Manhattan, but it is tightening up.
The better
market.
story, I mean, look at Stanford and Greenwich.
Greenwich.
Well, that's a real
Stanford.
location.
Stanford
well.
is not doing as well.
It's not
I
doing-
can tell you that in 1996 we bought the Ritz Plaza, and we paid we got $24 a square foot. Today I saw some leases that were signed, and we signed at $64 a square foot. So you do the calculation and see the growth, and this is again to my answer: how do you buy in Manhattan with low cap rates, and where the market is taking you?
It's going to be levered to the market, is what Ofer is saying.
But you're in Long Island with this new project. Jim lives in Long Island. Long Island there's not enough office space out there. I mean, what's your opinion of, there's a lot of shopping centers. Jim, you were a major player. The conversion of Roosevelt Raceway.
Right.
Michael, you have to
Okay.
understand, most of the people in Long Island, they go shopping and they play golf. They don't work.
and they work in Manhattan.
Can you edit that out of the tape?
No. So you're saying to me that there are no working people in
I live in Long Island. It was just a joke. I live in Long Island.
Boss is watching.
But,
Thanks for that offer.
But
Michael, we owned Gateway, right,
yeah.
at Lake Success.
Explain what Gateway Lake Success.
It was a office building complex built in the early 80s, okay? Four buildings, approximately 1,300,000 square feet. It was broken up when the guy went bankrupt and individual lenders took it. And we ended up with two from GE, the lender that took it back over a decade ago. And we had a relationship with them, and we bought it from them directly. There was no marketing process or anything like that. And we went out there. It was the strongest, suburban market in America, okay? But at the end of the day, it's a suburban market, okay? While rents in Midtown Manhattan went up $20, rents at Gateway went up $1, okay? It's not levered to the market. And we sold it because there's no trajectory. The money we made was as a result of the fact that we went in.
Your cap rate went down.
Exactly. We fixed it up and we sold it fast. It was a like Ofer's hotel play, a quick in and out, okay? It's, in my opinion, humbly, it's not even remotely close to
No,
Manhattan.
and they still made a lot of money. You can still make a lot of money in those markets, but
Right.
it is. I believe that the city still has the more appreciation.
Everybody likes living on the waterfront. But the waterfront is, Greenpoint, Williamsburg, there are different waterfronts. What's your opinion of all these waterfront developments that are planned? All of these residential developments on the waterfront.
Everybody
Anybody?
wants to be on the waterfront. You said it. I think they're great. I think it's a reclamation of the waterfronts, and I think where they were once industrial, they are now taking advantage of the fact that there are views and there are natural aspects of being on the water that people want. People want that.
I think they're going to be challenged by the fact that they're going to need to bring amenities. They're far from transportation in many of these locations, and they're going to need to bring amenities. So they may sell the buildings or they may rent the buildings, but I think that they're going to find there's going to be greater turnover until the amenities come to the level of the building.
In the borough of Queens, there is a place called the Rockaways. And, Auburn and
We've
the
been there.
Rockaways.
That's the land of
financed
affordable
Auburn.
housing.
The land of affordable housing.
But it's a great example of people. You know what? It was people just didn't pay attention to the fact that you had this great asset on the water, and there was an opportunity to develop that. And I think it was a long time coming.
Do you, Harlem has redeveloped. People are going north of 96th Street. But certain people are trying to build apartments and trying to sell apartments in Harlem for $1,000, $800 to $1,000 a foot. Do you think that's going to happen?
I think so, absolutely.
You do?
Yes, I believe that. I bought several properties in Harlem on Fifth Avenue and 109 or 105th, 107, and I see the neighborhood is changing, and even the people that live there. If you do a good product, the key is what are you giving. If you do a nice apartment with a nice finishes, I believe that at $1,000 a square foot you can achieve there. And I mean, $1,000 square foot, this is almost like
It's
a
an interesting
price.
point. You'll pay $3,000 to be at the south end of the park. Why wouldn't you pay $1,000 to be on the north end of the park?
Yes, absolutely.
And would you pay $1,000 to be in East Harlem near a shopping center?
Well, location is important no matter where you are.
I think
Transportation.
you're
and-
picking up on one specific deal, but if you speak about the market, and at the market at $1,000 a square foot, you wouldn't sell their units 5,000 square feet for $5 million.
No, but
if you are going to sell
offer
700, 800,
Jim's Bank
yes,
was the lender when Renaissance Plaza was built. Nobody really wanted to lend. Nobody. This was a pioneering. You know, it was.
Well, clearly it was also a function of our commitment to community redevelopment as well. And so, yes, we are very much into growing the community in an affordable, building affordable housing and building commercial retail spots in neighborhoods that could use that. Yeah.
Jim, I have a question. Jim, and Ben, if you have to go to Germany on certain loans to tell them what you're doing, that you put in
I
the
do.
book. I don't know.
I don't either.
Oh, you don't.
You do?
Over half
we're
a
kidding.
billion we have
Oh
to
no,
do.
no. But what I'm saying is, if you tell them that I want to go to Long Island City or something like that, do they have any reservations? Or are they, Manhattan? They're different places. They're not local, as you said.
Branson, Missouri.
I mean,
There's actually, I think, a bigger level of acknowledgement and recognition of the markets than what would originally be anticipated and expected. We have 3 offices. We're in New York, Chicago, and LA. So we're across the country. As a natural result of that, we have to go outside of Manhattan to do business, and we do. So do we sometimes need to explain a little bit of a market here and there that's outside DC, Boston, or Chicago, and New York? Yes, but they get there.
Let me answer it in a less cavalier way. If Rob Rosania wants to take me to North Miami in an evolving area and buy a property that's ideal for a conversion, and he can tell me, look, come and see it, it makes sense, I'll go with him, and we will do it.
As long as it includes a round of golf.
To Bethesda on a similar transaction. If offer says we should go to Harlem for these reasons, I'm going to align myself with successful people, I'm going to go study it, and we're going to do it.
I think that my audience has had a great opportunity to get opinions from lenders, investors on the market, and I'd like to thank all of you for being here today.
Thank
Jim
you for having
Fitzgerald,
us.
Thank you.
Rob Rosani, Jim Hendon, Ofer Yordeni, Ben Marciano, and Alan Weissman.
Thank you.
Next month, we're going to talk only about the residential market in the tri-state area.
Major funding for this program is made possible by grants from HSH Nordbank New York branch and First American Title Insurance Company of New York, Perfect Building Maintenance, the Moynihan Group. Additional funding for this program is made possible by grants from Anataris Real Estate, C.B. Richard Ellis, Fremont Investment and Loan, Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Wickoff Group, Titan Capital.